Did you know CPAs work around the clock on taxes, audits? Yes, it's quite a shock. But business owners, they've got a dream. More tax saving strategy, that's what they need. Welcome to Proactive Tax Strategies. And we're here to take away high tax fears. We got secret magic in our hands. Tune in as we travel.
Welcome to Proactive Tax Strategies. I'm Patrice Sikora. Our host, Ken New, owner of Pinnacle Financial Wealth Management and team-based model consultant, enjoys diving deep into the world of tax strategies. And today, we have a special guest on the show with us, Joel Grushkin. Joel is the Regional Director of Cost Segregation Initiatives. CSI provides certified cost segregation studies under the auspices of the American Society of Cost Segregation Professionals, or ASCSP. There are only 50 CCSPs in the U.S., which means only 50 individuals nationwide have gone through the requirements to attain this certification, the highest in the industry. Two of them are Joel's partners, and one serves as the chairman of the Technical Standards Committee of the ASCSP. Mr. Grushkin brings 40-plus years of executive experience to CSI. His background includes 11 years with Ernst & Young as principal and director of the firm's management services practices. His cost segregation experience encompasses studies for developers and owners of commercial real estate. Joel was a founding shareholder and chairman of the private equity venture capital practice group of DHR International, the nation's fifth largest retained executive search firm. He's also served as chief operating officer of a national consulting firm and held positions of CEO, COO, and CFO in companies ranging from real estate development and financial services to retail and automotive. And now, Ken, over to you and our guest.
Well, thank you, Patrice. And hello, everyone. So welcome to this edition of Proactive Tax Strategies. I'm your host, Ken New. So if you're just joining us for the first time, this show, as the name indicates, is providing tax-saving strategies. These tax-saving strategies helping many people, but focused really for small business owners, high-earning individuals, and high-net-worth retirees, but also CPAs. Great resource for CPAs when you're trying to mitigate taxes for your clients. Very often what is invite national experts, local experts, those that have unique understanding of the tax code and help explain these tax strategies. Again, if you haven't joined us before, be sure to go back and give a listen to some of these previous episodes. You can catch them on our website, Pinnacle Financial Wealth, MGMT.com. Also, subscribe to our podcast, the Apple Podcast, the Google Podcast, Spotify. Go back and give a listen. Many good tax strategies. Today, though, we're going to dive into this interesting, I'm really excited about this subject called cost segregation. Joining us today is cost segregation expert, and his name is Joel Grushkin. Joel, welcome to the show.
Thank you, Ken. Thank you for the opportunity to be here.
Glad to have you. So I know we could go on for quite some time with this first question, but what is cost segregation?
Well, I'll try to keep it simple. Basically what it is an alternative way to depreciate commercial real estate or real estate that is being used for rental purposes. So if you have a client that acquires a building and say they're going to house their business in it, the IRS says a commercial building, whether it's a shopping center, an office building, et cetera, has a lifetime of 39 years. And you are allowed to depreciate the value of that building every year that you own it until you've used up the 39 years. So if I bought a building for $3 or $4 million, and the first thing I have to do is back out the underlying land because land itself doesn't depreciate. And then I would be dividing the remainder. Let's say the building was $4 million and it was $1 million worth of land. We have a $3 million depreciable basis. We can add to that improvements that we've made, but we would divide that number by 39, which is the number of years they say is a lifetime of a commercial building. And you would get 1/39th of that number every year to take off of your tax return. That's what depreciation is. Now, it works the same way on residential property that's being used as a rental. You can't do it on your personal residence, but if you're renting property out, whether it's apartments or single family homes, you do it the same way, except the lifetime is 27 and a half years. Now, the problem with that is when you start to break down a building, whether it's a commercial building or a home, there are many component parts to it, some of which do not have a 39-year life or a 27 and a half year life. So cost segregation is an alternative method of depreciation, which allows you to break the building down into component parts and depreciate those component parts over a shorter lifetime. So there's going to be personal property items that are going to have a 5-year life. There's going to be items that are on the exterior, like the land improvements, the walkways, the driveways. Those have a 15-year life. So it allows you to accelerate the depreciation. And it's really kind of based on things that would tend to wear out over time anyway, and you'll probably end up having to replace them. So it's why spread that lifetime? Why depreciate something that only has a 5-year life by the tax code and depreciate it over 39 years? It's just from a cash flow standpoint, doesn't make a lot of sense. So that's kind of what it is in a nutshell.
Okay. So there's a general depreciation component to it, and that's kind of the building itself. Then we have the personal property, a 5-year life and a 15-year life.
Personal property and specialty property. So if we were to say, let's give you an example of something that has a lot of specialty property. Let's say we have a building with medical offices in it or dental offices in it. There's a lot of things that are required in a medical suite or a dental suite that wouldn't be required in a normal business suite. So we have, because of the nature of the doctor's practice, you might have to have x-ray, you'll have a lot of equipment, and the standard amount of wiring isn't adequate for it. Depending on the doctor's specialty, you may not be able to use standard air conditioning because you have to have something that purifies the air. So when we get into some of these items that are a requirement of that business or profession to practice, then those items are categorized as specialty items. And even though standard plumbing in a building has 39-year life, if it's specialty plumbing, in order to, like in a doctor's office, you have to have a hand washing station in every exam room. Well, that has to be plumbed for that. That plumbing is considered specialty, and the lifetime on it is 5 years instead of 39 years. So that gives you the opportunity to accelerate those costs and depreciate them much quicker. And when you can depreciate more on a quicker basis, you end up with better cash flow. And that's what cost seg is really all about. It's a cash flow tool for tax planning.
Yeah, I was thinking of what the purpose generally would be, but if you're able to create the depreciation early in the cycle of owning, I mean, you don't have to wait till 39 years. A building that's designed, as you said, for dentists or specialty uses can have it sounds to me like, I mean, help me if I'm right here, but that there's a varying different number of years that could be applied to a lot of different variables depending on the specialty of the business.
That's exactly right. I mean, it even happens in manufacturing facilities. You know, we have the basic building structure, the walls, the roof, and so on. That's always going to remain 39-year life. But based on the nature of the business that's going to be housed in that building, what would be considered standard electric may not be adequate to run all the equipment that you're going to bring in. If you're doing some sort of manufacturing process, you need all kinds of different power. And so When we have to bring that power in that isn't standard in the building, that goes to specialty as well, because that business can't function without it.
I love the nuance. So, how does a business owner know if he has this ability to talk to someone like you about cost segregation? He's bought a building. Let's take an example of somebody who wants to buy a building and then someone who's been in the building for a period of time. How does a typical small business owner or even someone who owns the building but is using it as a rental,
Okay.
how do they know?
Yeah, we would hope that it would be something that their CPA would bring up to them. If the CPA is proactive and if the CPA has spent a lot of time dealing with real estate, it may come from a financial advisor who then brings that to the CPA or directly to the client. And then they've got to bring someone in, such as ourselves, that specialize in this. Because the part of doing a study the correct way is breaking down the building. So we'll start with let's say it's a building that's already been built. Maybe it's been around for 50, 60 years or whatever. And a client goes and buys that building. So if the building is adequate for them when they buy it, they don't have to make a lot of modifications to it, then we can study that building right away. And we take a set of building plans and we do just the opposite of building the building. If you were going to go build a building to house your business, you'd go get an architect, you'd sit down, you'd talk about what it is I want in the building, what I think it should look like, how many floors and, how many suites and so on. And then your architect would do some plans, do some drawings. And then once you agree to those drawings, then the architect has to go out, or a general contractor, and get bids for every one of the specialty trades that have to be done in that building. So electrical, plumbing, the framing of the building, HVAC, could be gas distribution, depends on what's in the building. And each one of those specialties comes up with a bid for what it's going to cost to do their specialty. And that whole thing comes together and eventually it gets built and there's your finished product. Now, on some situations, we will deal with a client that just built the building. So we'll go right off of their existing plans. In other cases, we have a client that is buying a building that is 20, 30 years old. So what we have to do is find the existing set of plans from when it was built and what other things have been done to it over the years. And we do the reverse. We do a takeoff from those plans and we break down what the value of the plumbing system is, the electrical system, all those systems that I mentioned, put values on all that. We also break out all of the things that we can put in short life. So inside the building, it's the wall coverings, the window coverings, the flooring. There might be some specialty lighting. If it's medical, then we're going to have sheathing in the walls for X-ray. We're going to have a lot of specialty wiring, specialty HVAC, and so on. If it's a manufacturing facility or an office facility, we might have different kinds of things, but we still break out the short life that can be accelerated. And depending on where we are in terms of what the tax code is saying in a particular year, we basically apply the tax code to it. We've had some years where we've been able to take 100% bonus depreciation on everything that we could get into 15 years or less in terms of lifetime. And now we're at a point where we're at 60%. We may be going back to 100% again, but we just don't know. But that's what we do. We break it all out. We put values on every part of the building. And part of it is, and a lot of people look at cost seg as being, how much of a bump can I get right away when I acquire the building? So how much can you get into short life so that I can get bonus depreciation on it? But the bigger part, and always the bigger part of your building, are in things that we can't get short life in. So we want to put values on all those things so that down the road, as you're operating your building, and let's say you have a roof that has to be replaced, or there's a big plumbing problem and it makes sense to just replumb the building. Well, if you're tearing out the old plumbing system or tearing off the roof, you can go back to our report, which tells you what it was worth at the point you bought it. You can then back out how much you've depreciated it. Let's say it's been 2 years or 3 years, and the remainder has not been depreciated. It's still sitting on the books. So as you tear that out, as long as you know what the numbers are, you can take a write-off and just write that off on your tax return. Put in the new and start depreciating all over again.
Interesting.
That's why we break it out the way we do.
Sure. So there's strategy within this strategy.
Yeah, it's a tax planning strategy because the proactive CPA and the advisor working together are going to look at what is that taxpayer situation, let's say this year, what was it in prior years? If we have a situation where we will do studies right at the beginning of a purchase or right at the start of the build or once it's completed, we'll also do what's called a look back study. So let's say the client has been using the straight line depreciation method. Maybe they've had the building for 5, 6, 7 years. We come in and we take a look at how much depreciation they would have been able to take had we done the study right when they bought the building or right when they built the building, between then and right now. And we compute that using our methodology, determine how much they could have taken. We back out what they've actually taken. The difference they can take all at once on their current year's tax return without having to amend prior year's returns. And then they use as much as they need and they carry the rest forward into future years. So that's where you start getting into the tax planning side of it. Now, there's some situations, and it doesn't happen as often, but let's say we do a study and we come up with $700,000-800,000 of depreciation expense that we're going to catch them up on. And let's say it happens to be in a year where they can't use all that. But maybe the year before or 2 years before that, they paid a lot in tax. Well, this can be applied against those prior years, and you can go through the process of doing a formal amendment and getting money back from the IRS. Now, it's a drawn out process, more expensive, so it doesn't happen as often, but it is a possibility.
Well, then, so now I'm hearing the complexities and who actually, now look, I've had some discussions with tax preparers in the past and a few CPAs, and cost segregation is something that was never really gone into the depth that you've just explained. So is it your place to help CPAs with these filings and such, or?
Yeah, the way our firm is set up, the vast majority of our business comes as direct referral from CPA firms and financial advisors. And we kind of work as a team as their outside source because cost segregation is all we do. And there are certain skills that most CPAs, frankly, aren't going to have. And that is the breakdown of those building plans, doing takeoffs, reading those blueprints, and being able to determine what the various values are of the various line items that when we get through with the study, we've kind of developed a database on that specific building where in our report, you will see the value of every piece of pipe in the plumbing system. It's everything that touches water, the drains, the sinks, and so on. You're going to see the same thing on the electrical system. On the HVAC, it's down to what the individual units are that are typically sitting on the roof of a commercial building. It's very, very detailed. And we believe that's the kind of detail you need if you're going to use this document as a tool over your ownership period of the building so that you can really maximize cash flow when you've got to do big repairs or big replacements. You want to be able to write that stuff off because it's typically going to happen before the 39 years is up.
Sure. Yeah, that makes all the sense in the world. So if I'm hearing you correctly, then you work directly with the tax preparers themselves and make
Yes.
sure that all this is done such that the IRS blesses it.
Yep.
And because the last thing we want is for the IRS to come back and now have their own take on it, which would be different than what we're expecting.
Yeah, and the big CPA firms, it used to be the big 8, and then it was down to 4. and now it's back to maybe 10. Some of those firms have their own cost segregation departments.
Yeah.
They've brought in people with engineering backgrounds and such to be able to do this work. And so, but the smaller firms, mid-sized firms, don't have the luxury of having those people on staff. That's why we have the relationships with so many firms around the country. And even some of our clients have big four firms doing their actual tax work, but these firms still prefer to deal with somebody that is a specialist. And so we've been able to maintain those relationships because they know this is all we do. And we were talking earlier, you mentioned one of my partners chaired the technical standards committee, and he's stepped down from that this year, but this is critical. He still teaches for several state CPA societies every year, doing the updates on real estate. I do some of that as well, but you have to have that expertise in-house, and we're all focused on the same thing.
Yeah. So what's interesting to me is that this seems to be so valuable. Does it put maybe the client at risk for an audit more so than just taking regular depreciation? I mean, what's your take on that?
Well, here's what happens. If we do a look back study for a client, that's where we go, maybe they've been doing straight line for 5, 7, 10 years. And we're going to do the study where we go back and recompute everything and bring them current. When we do that study, their CPA files with the tax return a form 3115, which is a change in accounting form. And basically what it's saying to the IRS is, you're going to see us taking more depreciation this year than we have in the past. And the reason is we have made an election to change our method of accounting from one approved method, which was the straight line stuff, to a cost segregation method, which is another approved method. As long as the CPA submits that form with the tax return, it's automatic approval at the IRS. And so the incidence of audits, we believe, is low. They are from our firm because we know the detail we go to, and we're doing everything following both the IRS guidelines and the American Society guidelines, which are even stricter than the IRS. And so we don't believe it triggers audits. We will tell clients there are some firms out there that are so focused on getting a big bonus thing up front that if those big numbers would be one of the things that would trigger an audit. And so if you're taking those numbers, you better make sure whoever's doing that report has really documented it and done it the correct way. The other thing we see sometimes that would trigger an audit would be if somebody is, let's say, renovating a building and they want to put it in service in time right before the end of the year. If you get too close to the end of the year, and let's say last week or 2 weeks of the year, you show the building going into service just because you can get that big bonus number applied to the current tax return, that's another point that would trigger an audit.
Mm-hmm.
So we're very specific with clients that you need to understand this is something that could get looked at because the IRS looks at that and says, these guys are trying to get this under the wire just to get that bonus number. And they probably don't really have it in service. And we've seen situations where we have said, along with the CPA to the client, do not put this in service. You're too close to the end of the year. And we've seen the IRS come in and say, this was a medical building, which was a total renovation. And they put it in service right around Christmas. And when the IRS came in, they said, okay, did you see patients in that building? And the answer was no. Did you bill patients from that building? The answer was no. What were you using the building for? We were training our employees. The IRS said, forget it, and disallowed the whole thing. Said, place it in service after the first of the year.
Okay, sure. Yeah, but typically the impact of cost segregation is going to be immediate. It's going to be something in that tax year as long as you're not on the edge.
Yeah. And in fact, the way we look at it is, let's say we do a study mid-year and, maybe it's in June or July, let's say, and it's not going to get filed until the following April. Well, once we have the result and everybody's in agreement on what the result is, if the taxpayer is making quarterly tax payments, they can just start reducing their quarterly payments because they already know what they're going to be getting.
Okay.
So we can.
Well, that isn't an immediate effect then, isn't
Yeah,
it?
we can get it to be an immediate benefit, as long as the CPA and the advisor are on board. And that's why it's all about cash flow and tax planning. And I'll just give you an example. During COVID, when COVID broke out and we saw all the restaurants, switching to takeout or closing up and that sort of thing, we had a client that came to us through an advisor and had 10 restaurants. And we looked at the numbers. They had been doing straight line depreciation. We got it down to 7, I think, 6 or 7. And now this was a taxpayer who had already set aside cash to pay the upcoming taxes. So they already had the cash, but because they had to switch to takeout and skimming down everything, they were going to have a cash flow crunch. So we came in and from the 10 or so restaurants, we got it down to 6 or 7. And we did look backs on each of those. And we ended up coming up with about $700,000, maybe a little bit more than that, $800,000 of catch up for them for their taxes, which meant the money they set aside to pay taxes, they didn't have to use for the taxes because we wiped out their tax liability. They could then use that cash for operations. And
Terrific.
kind of looks like, taking out of one pocket, putting in another, but it works.
Yeah. Well, that's enticing for sure for any business owner. So let's flip the script for just a minute, though. We've gone through the benefits. What happens if they sell the property? What happens when that business owner sells their restaurants or they decided that they wanted to sell the building? And how does that work for them?
Well, yeah, I mean, it could be any number of things. We're going through a situation right now with an advisor that called us as a dentist that's selling his practice. And I think he has a lab and a couple practice offices and was being bought out by a big group and was trying to figure out what to do with the real estate. And he was going to sell the whole thing with the real estate. And I said, well, has he thought about keeping the real estate and signing a lease with them? They're going to be a triple net tenant and doing it that way and avoiding having to pay a lot of capital gains on the sale. And so we now got them thinking about that. The other side of it is worst case, if it's somebody that the easiest out is to do a 1031 exchange, which means you're going to trade up into a bigger building. You're going to sell. It has to be timed correctly. You have to have an intermediary that does it because you can't take possession of the cash, but you're using that to trade up and therefore you're deferring your taxes to whenever you finally get out completely. Now, part of that discussion is what's the reason for selling? Would you want to stay in as an investor? Long term, looking at the individual, if you kept the real estate, what would you do with it? Would you pass it on to your heirs? What's the age of the client? Would they pass it on to their heirs? And we look at it through that lens and say, if one of the thoughts is that you would just maintain this real estate, lease it out or whatever, and then pass it on to your heirs, then you're never going to pay the tax on it. It's never going to get recaptured. And so, because that's the way the law is set up. But worst case, if I just go ahead and do an outright sale, I'm either going to be paying capital gains tax, but we've had the use of, if we've accelerated depreciation, we've had the use of that cash. So you have to kind of weigh what the benefit was versus what it's going to cost us. And a lot of the things too that get fully depreciated in a building, you might have already replaced, put, new carpet back in or some electrical or whatever, and you've been depreciating that again. So the CPA has to figure out what makes sense. And, you've got to look at what was there, how much of it's been used, what's the current value of it. And worst case, you pay a personal property tax on it, which is about 25%. So, but it just depends on the situation. And there's several ways around it. You can't generalize.
Yeah, yeah. I heard you saying, just for the listeners too, then that it is subject to the recapture rule, and that would be 25%. But as you did mention, and we've done many times for our clients, is to be able to do that 1031 and then continue to defer.
Yep.
And it would also still be eligible then for the step up in basis when we
Well,
pass it on to the next generation.
if it gets passed on to the heirs, then you will have a step up. And, typically what we see is somebody's owned it long enough that there's probably very little, if any, debt on it. And so you've got to go through the process of the appraisal, step up in basis. And that's when you do another cost seg study, because depreciation starts all over again. And it becomes very important because in a lot of these cases, they've got positive cash flow on those properties. So, if you're not paying interest, the only thing you're paying is property tax and maintenance and insurance. You want somehow a way to shelter that income. And cost seg will do that.
Absolutely. Well, fascinating subject. What else would you like to tell the listeners about cost segregation? I mean, you've covered a lot of ground here and emphasized, of course, the tax mitigation,
Yep.
as well as the cash flow and the immediate nature too. If we've got an immediate problem, someone who's got a big tax bill, Uncle Sam's got his hand out for $357,000, like one of my business owners right now.
Yep.
And then, it's like, oh, well, maybe we can create a strategy. And so there's an immediate help as well.
Yeah, and I think there's some misunderstanding. I mean, there's people out there that seem to think that you can only do a cost seg on a brand new building, which is incorrect. The age of the building doesn't matter. As long as the building was, as long as the current ownership has owned the building since 86, it qualifies. I mean, we've done some buildings that are 100 years old that somebody purchased. Every time somebody purchases a building, depreciation starts all over again. So age of the building has no bearing on it.
Yeah.
The other thing is that we've seen some situations where, we're in a funny market right now. And, we're in a market where there's going to be people that bought a building, let's say to house their business, and maybe they bought it on a 5-year note. So they've got a refi at the end of 5 years. And if that 5 years is coming up, a lot of these buildings aren't going to appraise because the values have dropped.
Yeah.
So if that's the case, they may have to put more cash into the building to get the loan on it. And if they've been doing straight line depreciation, we can go back in, do a study, a look back study, and create this depreciation expense that offsets the taxes they were going to have to pay. And they can use that to put more equity in the building. So there's
great strategy.
a number of little twists that you can do on this, and they can just make a whole lot of sense.
Sure. Yeah. You
The
bring
other
up
thing
great.
too, for people that, well, actually 2 points. One is, let's say somebody goes out and leases space, but they decide they're going to build it out, pay for the build out themselves because maybe the owner of the building doesn't want to spend that kind of money. This works on that tenant improvement. It works if the owner of the building pays for it, we do the study for the owner. If the tenant pays for their own, we had some doctors that built out a surgery center. Owner of the building didn't want to put out the $2 million. He did the study for them 5 years after they moved in, saved them $700,000 on their taxes that year by catching them up on what they could have done.
So I heard you say that you don't have to own the building even as
As
a
long as you paid
tenant.
for the improvement. So everything goes with whoever wrote the check. As long as it's not included in your lease, then if I'm leasing space in a building, I may look at can I get the owner of the building to pay for all this stuff? How much more are they going to charge me on my rent? Or do I have access to the cash so that I could pay for the build out and then take the big depreciation deduction and use that depreciation? And so it's something that has to be looked at, but I mean, it works incredibly well. And then you're also looking at it in the context of what's the current rule relative to bonus depreciation. I mean, we did a study for a doctor, a small one, $350,000 to build out a small suite and medical offices. And under the ruling that had 100% bonus in it, of the 300 and some $1,000, we got like 95% of it to qualify to take the 100% bonus. He got it off the first year, all except for like 10%. So it's certainly something that needs to be looked at.
Well, it seems to me that any small business owner, and especially the specialties, dentists, doctors, as you said, even restaurateurs, anyone who's investing in their buildings and has specialty equipment really needs to take a strong look at this.
Yeah, and it's the equipment portion. We do a lot of restaurants and some very high-end ones. The equipment is pretty easy. The CPA can take care of the equipment part. It's all that stuff that goes into the restaurant to make the equipment function that they can't get their hands on. So that's where all that specialty stuff is. The equipment you're going to take 7-year depreciation on, but the rest of the wiring and ducting and so on, we can get that into short life as well and take bonus on it. So it's serious numbers.
Yeah.
The other last point would be, let's say I own a business and I've been leasing space and I decide, you know what, I'm tired of paying rent. I'm going to go buy a building. I would typically set up an LLC and I would go buy a building and then I would lease it to my business entity, my operating company. And when you do that, there is a section in the tax code. As long as you own the LLC and you own the business, you can group the two together for tax purposes. By doing that, you don't have a situation where you have passive losses. So everything is active and it offsets the income. And it makes a huge difference. And it's amazing how many times we bring it up and we watch CPAs that either maybe knew it at some point in time, but because they don't do real estate all the time, they haven't maybe kept up on it. It's an area that makes a huge difference to that business owner.
So that just means you want to connect the dots, the LLC with the business entity itself.
Yeah.
Yeah, terrific. Yeah, subtle point. Makes a lot of sense. Now, before we let you go, we've gotten deep into this subject. It's awesome. But we also talked about current year 60% bonus depreciation. What's your take on it getting shifted to 100% depreciation? And if it does, do you think it'll be retroactive to the beginning of the year? What's your thinking on that?
Yeah, I think this all kind of came about in 17 with the CARES Act. And that's where that 100% bonus got set up. And then it was to drop off after 22 to 80%, then 60%, and dropping off 20% a year until it goes away. What we're seeing now is there is still debate going on in Congress about an extender bill. And now there's been extender bills before, and some of them have gone through, some haven't. And the way it's written is if they agree on the extender bill, we will go back to 100% bonus depreciation. It'll be retroactive. And certainly it will cover 23, the 23 tax year. It might cover the 22 tax year as well. The other part of this is, depending on the next election, depending on who wins, you could see 100% bonus back again.
And it will be,
we're guessing.
If it does come back, then we can go back and retroactive for this year.
Well,
then
that's the question we don't know. We don't know whether, if we wait till the 24 election, whether they would make that retroactive or not. We don't know. But I would say going forward, there would be a pretty good chance that if the Republicans are in, I think you're going to see bonus back again at 100%.
Yeah. Well, that's a great way for us to end our segment here today. Is not only stay tuned, of course, but so important that, the tax year's done for some people mentally. Like the 15th is finally deadline. Oh, we're done with taxes, but there's so much more going on.
Yeah. However, let me add this. Anybody that goes on extension, if they've already filed their extension, and they still have 3 days to do that. Actually, in California, they have they still have to file extension by April 15th. They extended some of the areas where we had flooding for another year, but anybody that goes on extension The study, if we were to do a study, it doesn't have to be done until prior to when they file their return. So we are still good to go till October 15th. We just have to get it done in time for their CPA to put it in the return.
Okay. Well, there's a pitch for extending rather than filing.
Yeah, and I know there's some guys out there that were running around prior to the end of the year saying, oh, you've got to do a cost seg, you got to get it done before the end of the year. That is just fake. And so it's never been the case. You've always had up until the time you file to get it done, or on an extension up until the extension is due.
Yeah, good tip. Good tip. And again, real important to stay tuned with tax strategies throughout the year, looking ahead, being proactive with these ideas. So, Joel Grushkin, thank you so much for your insight into cost segregation. What a tremendous tool, really, for so many people.
Well, it is. And the other thing, too, that we didn't mention is that before we take a study on, we always will do an estimate at no cost, because we want to be able to see, first of all, how much time it's going to take us to get it done and how difficult it's going to be. But we also want to be able to show the client within pretty close proximity what that tax benefit is going to look like.
Yeah.
And so it's about a 4-page presentation, and there's a lot of data.
Yeah, terrific. All right. Again, Joel, thank you so much for
My
the
pleasure.
presentation today.
Thank you,
Listen,
Ken.
everyone, check us out on Pinnacle Financial Wealth, mgmt.com. Get a copy of this recording here. Check us out also on Apple Podcasts, Google Podcasts, and Spotify. Joel Grushkin, thank you for your time today.
Thank you for listening to the Proactive Tax Strategies podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.pinnaclefinancialwealthmanagement.com or give us a call at 321-454-3623. Securities offered through Arete Wealth Management, LLC, members FINRA and SIPC. Investment advisory services offered through Arete Wealth Advisors, LLC, an SEC registered investment advisory firm. Pinnacle Financial Wealth Management, Arete Wealth Advisors, and Arete Wealth Management are independent entities.